Hi, Nathan here from Buyers Club. We've just seen the July HVI figures released by Totality, which keeps track of how property prices around the country are doing each month. As you can see, the market is still in decline. This is a measure of the 3 monthly change in dwelling values for the capital cities. Melbourne and Sydney are well down. Sydney house prices have fallen 4% in the past quarter, and Melbourne is now down 3.4%. Until recently, those were the only two major cities recording declines, but Brisbane and Perth have now also moved marginally down into negative territory. Perth is down 0.3% over the quarter, while Brisbane is down 0.6% now. Those are still relatively modest falls, but looking at the broader trajectory, the downturn appears to be spreading and could intensify. If the trend persists, Adelaide will probably also dip into negative quarterly growth by next month. So, looking at all of this, the obvious questions are, how long will this downturn last? And is this just a temporary dip, or could this develop into a genuine property market crash? Really, there are two obvious factors driving this at the moment. The first one is, of course, interest rates. Higher rates have reduced borrowing capacity, increased mortgage repayments, and weakened buyer demand. And then secondly, the federal budget's changes to negative gearing and capital gains tax have altered the economics of property investment. But they've also just added some uncertainty about what the effects will end up being. And that uncertainty really matters. Like other financial markets, property markets put a premium on predictable rules. So when governments make changes to the rules of the game, even before the full consequences are really understood, buyers can delay decisions, investors can withdraw, and you can see an increase in volatility. So the market is currently absorbing these two demand shocks at once, interest rates and the federal budget changes, but both are still demand side shocks. And when we examine some of the more serious property crashes in modern history, they've typically involved a combination of weakened demand, but also excessive housing construction in the years leading up to the downturn. That was certainly the pattern in the United States during the global financial crisis. You can see on the left here that big dip in US house prices following 2008. And if you look across on the right at the rate of housing construction in the US, you can see clearly that housing construction peaked at a historically high level just prior to the crash. So when lending and demand ultimately took a hit, the effect of that upon house prices was just amplified by that abundance of housing supply. And other crashes have shown similar characteristics to this as well, like Spain in the early 2010s. But Australia just doesn't share those same characteristics today. Demand has definitely weakened, but Australia hasn't spent the past several years building too many homes. And actually, we've not been building enough. Probably the clearest evidence for this is Australia's performance against the National Housing Accord. This was the national housing target set by the government of 1.2 million new homes over the 5 years to June 2029. And that target works out to 240,000 homes a year, or 60,000 a quarter. But since the Accord period began, quarterly completions have generally been running between only 40 to 45,000 homes. So currently we're almost 30% behind the required construction rate, even after just 2 years of this program. And if you break that figure down by state as well, you can see that the worst shortages are really concentrated in a few states in particular. So obviously every state and territory is behind the construction rate required to meet its target. In percentage terms, though, the Northern Territory is furthest behind, followed by Tasmania. Of course, these are fairly small housing markets. So probably the most significant result here is New South Wales, which is actually around 41% behind the required construction rate. And that's a shortfall of more than 50,000 homes in actual figures. Queensland is 31% behind, which is almost 27,000 missing homes. Western Australia is around 17% behind. South Australia is 20% behind, and Victoria is a lot better, but still down at a shortfall of 9%. So, of course, as we're already seeing, prices can fall because interest rates and tax changes impact buyer activity. But it's hard to see an argument for a prolonged price crash when the country is more than 100,000 homes short of what it needs. And the fact that prices are falling at the moment might actually make this supply shortage worse. This is another really interesting chart too, comparing growth in residential building approvals with changes in dwelling prices over time. And historically, the two have moved together quite closely. On the whole, when house prices spike, building approvals do too. There's quite a strong correlation between the two. So conversely, when house prices fall, building approvals do as well. And really that makes logical sense that developers, they only build when the expected selling price of a completed property is sufficiently greater than the combined cost of land, construction, and finance. So as property prices rise, more projects are becoming viable, but developers become far less active when the value of the property might fall before they can even finish building it. And that problem just becomes even more severe when property prices are falling alongside a situation where construction costs are still increasing. And that's exactly what's happening right now. After briefly declining early last year, new dwelling purchase inflation has accelerated again. So developers right now are really being squeezed from two different directions. The expected value of the finished property is declining, while the cost of delivering it is still going up at an increasing rate. And overall, that just means weaker margins, fewer viable projects, and then in turn, ultimately fewer homes being completed. And it's important to bear in mind too that there's a substantial delay between the effects of prices falling right now and how that later manifests in the construction figures later this year and throughout next year, just given the length of time it takes for a new building approval to turn into a completed house. So today's weaker development conditions might not immediately appear in the numbers, but the effects will be felt over the next several years, which then creates a feedback loop for the market. Falling prices reduce development feasibility, which restricts future construction, which then just makes the underlying housing shortage even more severe over the long term. Of course, none of this prevents prices from falling today, but it does help to create a floor under the correction and supports the longer term outlook for price growth. And we can see further evidence of that continued shortage in the rental market. If Australia did have enough homes, we wouldn't be seeing the kind of rental market behavior that is happening right now. The rate of rental growth has risen across the board for every capital city over the past year. And the consistency of the trend is really striking. Clearly, you can see there's obviously prior years on the chart here where rental growth was higher for certain cities. But at least from what's shown in the chart here, we've not seen a situation where rents have accelerated in every capital city simultaneously. So while right now demand from buyers has clearly taken a hit, it just goes to show that people still need somewhere to live, and the underlying demand for housing as a whole is still incredibly strong. And this combination of rising rents and falling prices is starting to have an impact on rental yields too. Gross yields have started to lift again, now at approximately 3.6% across the capital cities and 4.2% across regional markets. So as prices are falling and we see rents rising, these yield numbers will continue to improve, which will end up making property investment increasingly attractive, which starts to lure investors back even before any major capital growth arrives. And there are already some early signs that investors might be starting to respond to this. According to these figures from Ray White, investor auction participation, as expected, fell sharply immediately following the federal budget. It fell down to 21% of identified buyers by early July. But it's since recovered back up to 23.3%. That's clearly still below some of the levels recorded over the previous 18 months. And obviously, this is still early days. A few weeks of data isn't enough to establish a clear trend. But this is really interesting to see, despite the narrative that the budget has really killed off investor demand for property. We might have expected that the downward trend would have been persistent, but that doesn't seem to be the case so far, at least by this measure. So this is potentially an early sign that investor demand will remain more resilient than we expected. And it isn't necessarily the case that we won't see price growth again until interest rates begin to fall. Because as we've seen from rents and yield growth, there can be other factors that help to reinforce the aggregate market demand. On the subject of interest rates, though, the conversation has been evolving a lot recently. By the time this video goes up, we might already have our next announcement from the RBA, but at the time of recording, it looks like a hold on interest rates is ahead for the near future. Inflation is still above the RBA's target, but the chances of another rate increase have fallen significantly as the inflation trend looks to be stabilizing. And in fact, CommBank, NAB, and ANZ all now expect interest rates to stay on hold for the rest of this year, followed by a first cut sometime next year. So where does all of this leave us? Well, it does seem like the correction has a bit further to go through the remainder of this year, but it does look a lot more like a short-term correction rather than the beginnings of a huge market crash. We are still well behind our national housing supply targets, and the longer that prices remain weak while construction costs are elevated, the more difficult it becomes to actually deliver that supply that's needed. At the same time, we've seen that rents and yields are picking up, investor activity hasn't collapsed, and the major banks expect that interest rates will be falling again as soon as next year. So, of course, nobody can pinpoint the exact moment at which the market will turn around and start to grow again. But my view is certainly that this phase of the market will be far more a matter of months than years. That's my thoughts on the market right now, though. Do you agree or disagree with the analysis? Let me know your thoughts in the comments, and we'll see you in the next video. Thank you.